Okay, good morning, everybody. I want to thank everyone for hopping on to this month's Industry 30. I'm pleased to introduce our speakers today. We have Joel Gilly and Charlie Thiel from Promise Financials. They're both new associate members of the chapter, and we're happy to have them. Today, they're going to be talking about keeping your best people, retention engineering for electrical contractors, which is very relevant in today's world. For today's presentation, you all have the ability to unmute yourselves. So if you have any questions, please hang till the end, or you can use the chat feature if something comes up mid-presentation. This presentation is being recorded and will be uploaded to the chapter's website later today, so you can refer to it later. If you need anything in the meantime, please let me know. With that being said, I'm going to turn it over to Joel. Take it away, Joel. Thank you.
Thank you, Rob. Appreciate the opportunity to present to this educational webinar, and we're so far enjoying our membership as associate members. And thank you, folks, for investing your time this morning. We hope it's helpful. It certainly is a timely conversation. When Rob and our team began speaking about doing this webinar, we made clear that this is perhaps the hottest button that you all are wrestling with right now. And, there's an obvious visible challenge with regard to recruiting and keeping electricians in your stable with workforce competition, union labor bidding wars, sign-on bonuses. In fact, we came across a situation out west where a major contracting bid included 2 catered meals a day for 2 years to attract union electricians, and it was over a $1 million line item in the budget. However, there's an invisible challenge that sort of sits above the field, and that is your estimators, your project managers, your GMs, et cetera, those folks who have the institutional knowledge of your specific organization, own your client relationships, and ensure operational continuity. And those folks are at risk as well. And that's going to be the sort of the focus of today's presentation. So we'll spend a couple minutes just framing that issue. Then we'll jump into a solution that Promise works on to help recruit, retain, reward, and retire your best people. After that, there's a 3-question self-assessment that we'll take a look at that you can sort of open book test for yourself or take back to your organization. We'll then shift gears for just a few minutes and talk about a benefit that is not based upon retaining and rewarding your key people, but is based specifically as a benefit for the owner or the owners of the organization. And it's a very tax-focused solution. And then the part that I'm actually looking forward to most, which is the conversation with Barry Spade. Barry is a NECA board member, president and owner of Pagoda Electrical, and a 10-year client of Promise Financial. So I think you'll find probably a lot more value in his 5 or 10 minutes than you'll find in my half hour of speaking. So looking forward to that part as well. So let's jump straight in. Everybody's talking about the challenges of the field force and retaining electricians. Again, perhaps the higher risk to your organization is the people within it and the people above that field force. Your senior project managers that own the client relationships and probably have deeper relationships with those folks than you do because they talk to them every day. Your lead estimators who know where your competitive advantages lie and unfortunately where your competitive weaknesses are. And they're be juicy candidates for your competitors to pull over. CFO controller, those people that run your financials. If any, move this. If any of those folks walked tomorrow, the question is, how long would it take for you to recover? And that's a that recover is a crucial word because we're not talking about replacing them. That's a pain and an expense in and of itself, finding somebody to fill the seat of one of your key employees. But to truly recover uh, can take months or years for a project manager to understand your company, to understand your workforce, to understand how you operate, and the risk, the long-term risk and cost of replacement is more than just the cost of their salary or bonus. I want to talk about a bit about why salary and bonus oftentimes are not enough to keep these people. A salary increase or a bonus is great, it's appreciated, but there really can be a "what have you done for me lately" uh, uh, rebound after a very short period of time. Your competitors can always offer the next 5 grand of salary increase as a way to compete for them. And oftentimes, or all times, there's no cost to an employee for leaving. There's nothing left on the table. One of the convictions that we have at Promise is that every one of your key employees should have something at risk in the event that they left the organization. Similar story with annual bonus. I'm sure you've all experienced whether you pay your bonuses out right before Christmas or January 15th or March. There's always those couple of employees that stick around and then leave after the bonus is paid. So we believe there's a better solution, and that better solution would include a multi-year program that vests over a long period of time, which we'll talk about in just a moment. That better solution would be custom designed by the employer. That better solution would give the employee a quantifiable stake, a building value for staying, and similarly a direct cost if they don't, and a benefit, a better solution that a higher salary can't compete with. But importantly, does not include giving that employee some ownership or equity in your company. So we're going to jump into that solution. We call it a supplemental employer retirement plan. And again, it is a very effective tool, not just for retention, but for recruiting, for retaining, for rewarding, and retiring your most valuable people. So what is a supplemental retirement employee retirement plan, which a SERP? A SERP is importantly employer funded. It's an agreement that promises a key employee a future benefit paid out over time in exchange for continued service. Importantly, it is let me turn on the importantly, it's supplemental to the existing salary and bonus, kind of sits on top of those. It doesn't replace them. Um, I will say that there are clients of ours that over time sort of segue some of the upfront cash bonus into a split between current cash and deferred bonus via a SERP. Um, um, you know, some folks ask the question, well, we're already doing salary and bonus and profit sharing. Isn't that enough? And in today's environment, unfortunately, that's often not enough. The trade-off is that you build loyalty for an employee for a career. Um, Importantly, unlike a 401k or profit sharing plan, SERPs are not subject to the participation and contribution limits inherent in those plans. As you well know, in your what are called qualified plans, your 401k and profit sharing, everyone has the opportunity to participate. In a SERP, you can look across your employee spectrum and include just those very crucial key employees that are most important to your organization. You get to set the contribution amounts. You get to set the vesting schedule. And as I said, we're going to talk about that in a moment, which is really sort of the crux, the power, the magic of the supplemental retirement plan. And importantly, you get to set the forfeiture terms. We do have the ability to put non-compete and morals clauses the program, so that if a GM leaves and takes your best PM with them, they can forfeit their benefit and you recover it back as a owner. Um, there's no current cost to participants, very much like a 401k plan. Plan contributions and earnings are tax deferred until payout. And then the participant pays tax at that time as it's distributed over time, which actually helps because presumably that employee will be in a lower tax rate later in retirement. And lastly, the benefit is backed by the company's general assets, not a separate trust. So there's maximum flexibility and control for the employer. I do think it's important just to mention that in the very unlikely event of a bankruptcy, those assets could be made available to creditors. So I mentioned briefly the power of vesting, which I want to spend a few minutes on this slide. If there's one concept or idea that's really important, this is the one where you don't be texting or checking your phone for. It would be this slide, talking about the power of vesting and the golden handcuff. So um, these programs generally include a much longer vesting period than a qualified 401k or profit sharing does. I want to show an example of a 50-year-old here that has a $200,000 salary. This SERP design is just a very simple level, 20% of salary, so $40,000 a year into the supplemental retirement plan. So the vesting schedule here, which is one we use quite regularly, would be zero vested for the first 5 years. So you'll notice a real difference from your 401k profit sharing. So in the event that the employee leaves in the first 5 years, they get nothing. And then it vests ratably from year 6 on. So in this simple math example, from age 55 to age 65, and we assume 65 as the retirement age, um, excuse me, the employee would vest 10% per year. So at age 65, that when they get to the end of the rainbow to the pot of gold, what you'll see is the green line at the top represents the account balance, which is the contribution plus earnings year after year after year growing. The dark line represents the vested account balance. So as you can see, if this participant were to leave in 5 years, there'd be almost $300,000 left on the table that they would walk away from. And this gap, this vesting gap, is really the crucial cog that we encourage our clients to focus on. So, and again, in this case, we're talking about almost $300,000. When the competitor comes calling and offers 5, 10, 25, $50,000 more salary, it just can't compete with the gap that the participant views when they take a look at what they're going to walk away from. A couple other comments about the power of vesting. This is a 50-year-old employee. For example, if let's say you had a 55-year-old employee that's been with you for 30 years, I'm guessing you wouldn't want to require that employee to wait 5 years before they start to vest. So that 55-year-old would begin vesting at 10% a year, right off the bat. Similarly, let's say you hired a 35-year-old or had a 35-year-old that you realize you think could be a superstar, salesperson in the future. You could put that person in the plan, and if they end up flaming out, if their talk is better than their actions, and you decide to get rid of them in the first 5 years, you haven't lost the dollars of paying out bonuses because anything contributed to the SERP reverts back to you as the owner. The last point about the vesting is that you can actually, as I've just verbalized, you can actually customize vesting per employee. So we have our enrollees sign a participation agreement that can have a customized vesting schedule within it. So you can treat that that 50-year-old, that 55-year-old, that long-term employee differently than the young bucks that you're trying to retain for the long term. Before we shift out of this, I really want to, I know we have owners on the call, but we also have some key employees yourselves on the call. And I almost created in this slide a second slide called the golden reward. True that the purpose of vesting is to aid in retention, but I just don't want, I'd be remiss if I didn't focus on the reward part of this for participants. The account balance is a growing reason to stay. It's a growing reward for your loyalty and sticking with your employer. And this pot of gold, I just want to point out in our simple example, is $1,000,001 in value, in excess of the 401(k) plan, in excess of the profit sharing plan, really creates a value that you could probably never create on your own. So I'd be remiss if I didn't focus on that part of it as well. Don't want to spend a lot of time on this slide, but it's just meant to illustrate the fact that your contributions, don't have to be just flat dollar amounts. We do have clients that have a simple design, again, particularly when it's focused on trying to fairly uh, um, uh, reward a long-term employees that have levelized contributions. We always say we have clients that sit with a yellow pad and at Christmas time with in front of the fire with a bourbon and their dog at their feet and just write down the names of their key people and create a contribution based upon their perception of their value to the organization of the year during that year. But we also have clients that use very quantifiable key performance metrics, revenue growth, gross margin, on-time completion, on budget completion, those kind of things. So don't want to belabor that too much, but just state the fact that there's incredible flexibility and variability in these programs. The one warning we always give our clients is to not make the calculations so complex that your key people don't understand it. Because if they don't understand it, they don't value it. And if they don't value it, you're wasting your compensation dollars. So is this right for your business? This is just kind of a simple slide of the kind of characteristics that might imply a good fit for a program like this. The first would be relatively consistent profitability. There needs to be an element of predictable excess cash flow to be able to fund a program like this. I will say very importantly that when we enroll our participants, we always specify that these contributions are voluntary based upon sufficient profitability of the organization. So, if there's a project that goes bad or there's an on-site accident or something, and it causes a financial break for a year, there is no requirement to fund these programs on an annual basis. Secondly, just having some key employees that you value and that are important for the organization to retain. And as we've already demonstrated, this is really targeted to the people who, if they left, it would really harm the business. Once in a while, I'll get a question from a client that says, how do I know who my key people really are? And we sort of tongue in cheek say, if you came into your office on Monday morning and there was an envelope with your name on it and you opened it up and it was a resignation letter and you say, oh shit, what do I do now? That's probably a key person. Lastly, retention horizon. And, the horizon from a standpoint of your key employees is that they stick around for the entirety of their career. But there's also a horizon for you as the owner, and that could include your own transition plans, whether you're looking to sell the company, the EC eventually externally or internally, or pass it on to a son or a daughter. it can be really crucial that you keep your key management team together during those transition periods. We do some valuation work for companies, and there's actually calculations in valuation models where if you have a specific targeted plan to keep and reward your key people, it actually increases the value of your business. And then lastly, just a desire to differentiate. I don't need to spend a lot of time on that. We've already talked about the fact that salary plus bonus oftentimes is not enough in and of itself. So customized strategies like this just allow you to differentiate and prevent the employee from considering the phone call when a competitor calls asking for them to move to their organization. So I mentioned the three questions, the self-assessment questions, and we're not gonna spend a lot of time on them, but I would encourage you to copy them down or access them after this presentation, and just to think through what your answer would be. And I'll just read them in order. Do I have one or more key employees whose departure would materially harm my company's operations, client relationships, or revenue, and I have no structural mechanism to prevent it? Do my key people have a compensation package designed specifically and targeted to them to give them a quantifiable financial reason to stay beyond their next salary increase or bonus? And thirdly, if a competitor offered my best person a structured program like this today, am I set up to compete? So if the answer is no, or I don't know to any of these three questions, we would invite you to engage on a complimentary basis with Promise in a next step analysis. And we just internally call this the key employee benefit gap analysis. Again, it's a complimentary diagnostic that we offer through NECA, no cost, no obligation, no heavy sales pitch. We'll schedule a 45-minute or so Zoom or Teams meeting where we'll talk about your business. We'll talk about who your key employees are or might be. And we'll talk very briefly about your current compensation structure, get a census from you of those key people. Then we go away, we model to your specific situation. We model a hypothetical SERP program, what it would look like, what it would cost, who it would include, what the vesting would look like if we define a vesting schedule. And as I mentioned, there are numerous different ways that we can vest these kind of programs. And then we'll come back and we'll present our numbers to you. You can take a look at it, see how it fits within your current compensation program. No pressure. You decide if it makes sense to continue the conversation. If no, you've just learned a few things. And if yes, then we can go from there and continue the process. So I alluded to in the beginning that we're going to talk briefly about a second program that is completely focused towards the owner. So I want you to sort of think in your mind, new paragraph here. And this is a highly tax-driven approach that overlays on top of what you're currently doing in your 401k and profit sharing program, and it's considered a tax qualified program. So all contributions are fully tax deductible to the organization. But again, because we marry it to the existing 401k / profit sharing program, you can create a category that just covers owners. And what it is an actuarially optimized program, and that's a fancy schmancy way of saying that we look at how old you are and how much you would accumulate at the end of your career, as opposed to an annual contribution like a 401k plan. And we back into a defined benefit pension contribution that concentrates the tax deductible contributions just on the business owner. It's legal, it's IRS approved. Pension plans have been around for decades and decades and decades. They kind of went out of style during the 401 as 401ks became the standard way to compensate your key employees, but they never disappeared. And in fact, they increase every year with inflation, and at this point is an incredibly attractive program for the right business owner. So kind of who's it for? Just realistically, it's an owner with 300,000 or more of annual taxable income with a relatively consistent amount of excess cash flow that the organization generates beyond your need for operations, and a desire to significantly, drastically reduce your personal tax liability. So, kind of the crux question here, as an owner, if you could put an unlimited amount into your 401k on a fully deductible basis each year, how much would you put away? And that's if that number has any significance to it, then we ought to have a conversation about whether this kind of program overlaid on top of your existing retirement programs makes sense. Um, I don't want to spend a lot of time on this because I'm anxious to get Barry in the mix here, but this is an example of an actual client of ours that was putting $19,000 towards their own retirement before implementing the program. And after we put the program in place, it was over $250,000, 90% of the total flow, $85,000 in tax savings. So that's the end of our prepared remarks. Rob, I guess wanted to invite Barry to come back into the picture here um, and have a conversation with him.
Thanks, Joel. Barry, you should have the ability to unmute yourself.
I think I am. Can you hear me?
Yep, we can hear you.
So before we jump in with Barry, I think it's important to hear from Barry because he's one of you. And then again, let's accumulate any questions for either Barry or I don't think I specifically asked you, Barry, but I'm assuming you're willing to answer some questions after we finish our couple of minutes together. Um,
Absolutely.
so so I remember the first time we met, like I guess it was about 10 years ago. You had just become owner of Pagoda, and we were introduced actually to help you with how much life insurance the company should have on your life as a new owner. During that meeting, we happened upon a conversation of your 401k plan, had 4 or 5 participants in it at the time. And I just wanted to ask you, how did that compare with what we were able to come back with and present via the defined benefit plan overlay that we just looked at that last slide?
Yeah, well, obviously the defined benefit plan that you brought back to me is what I've been doing ever since. It's a huge benefit. It makes total sense. It's put a lot more money in my retirement account, tax deferred, for the last years. Like I said, I'm a year away from it being fully funded. And so the numbers we set back then, and my wife got brought on, and we can continue to do it with her as well to put tax into hers because we created a defined benefit for hers. I think it was like 2 or 3 years later, Joel.
Yep, that's correct. That's correct.
So it's a great program. It's something you definitely should look into.
And so what we'll do, you and I were just talking about this yesterday, at some point, once the bucket is full, if you will, we just terminate the pension plan part, you roll it into an IRA and kind of away you go. And there are a couple of different ways to handle that. So let's shift to the main topic of the webinar, which was the retention reward of your key people. What caused you to realize that you wanted or needed something more formal for your key people rather than just salary and bonus?
It was something I think I started it 3 or 4 years ago, and it was just a conversation you and I had, and you said, well, we have this program, and I thought about it, and the way we structured and set it up, it wasn't a huge burden to the company, and I just put 3 people on it at the time. And fast forward to about 2 years ago, year and a half ago, when someone came into our market in Reading here and tried to take my key employees, and it it was a big help for me to keep them. I lost a couple in that process. They weren't key employees, but I mean, they came after my top people and they came after them hard. The offer letters were crazy what they were offering. And it wouldn't have been for this package that I had set up with the retirement and the vesting and program, I might have lost them. I don't know, but it definitely helped me retain them. So, and with the way the market is today, in my opinion, there's just not enough qualified people in our industry across the board, from workers to office to management. It's thin everywhere. And I foresee companies, the only way they're going to get people is trying to get them from other contractors. So it's just another layer to help you keep your key people.
Mm. Great, really powerful answer, Barry. So the last question for any NECA contractors, listening today who's sitting where you were, salary bonus, a handshake, and a hope for retention. What's the first question that you think, or the first step they ought to be thinking about?
I mean, looking back, I would say you just can't assume all those things you're doing. I mean, we probably all pay our people well, but every market's different. In Reading versus Philly, there's a big gap, you know, in salaries. I mean, still, you don't know. I mean, I wasn't sure. I mean, you don't know what's the right number. You pay your guy what you think you're getting paid in the area and the people you know in your region. But you got people coming from all across the country trying to get these people now, and you're going to work with them on these bigger jobs with all these big players. You have partnership. You know, I'm in a project now where I partner with a company out of Pittsburgh. Fraser here in Reading's partnered with a company out of New York City. So there's a lot of different players, salaries coming in different areas that these people are seeing that's available in these data center worlds. I mean, money, I wouldn't say and it's not important, but they're spending money like it's water right now. Got to get these jobs done. So
Great, great. Well, Rob, that's I think that's what we were planning on sort of communicating. And I guess if you want to open up for the floor for questions and comments, and again, thanks Barry for being willing to jump in here and share your experience with Promise and in your company.
Absolutely. Thank you, Joel. And hey, Barry, thanks for hopping on. So everyone does have the ability to unmute yourself. So if anyone has a question, feel free to ask now. We'll leave it open for a couple minutes. You could also use the chat feature if you'd prefer to type it.
Yeah, I have a question, Joel. How does this work for union employees? I've got estimators, project managers, all of my foremen are all union members.
Yeah, I'm not going to speak to the union side of it, but I will tell you that there's nothing from a regulatory or legal standpoint, from standpoint of our part of the business, that requires you or that keeps you from doing this kind of an approach for those key people. In fact, we do have clients that are in your situation that those key people are card carrying union members.
Got it. Thank you.
One more minute for questions. Hearing none. Joel, thank you again. Charlie, thank you for hopping on. And Barry, thanks again for your remarks. I will be sending up a follow-up survey to this presentation with contact information for Joel and Charlie, so you all can reach out to them via email. I'll have a link there. You can review the seminar, and then I'll also put a recording of this on the chapter's website. Once again, I want to thank everybody for hopping on this morning, and I look forward to catching up with you on the next webinar. Thank you and have a great day.
Thank you.